Owning a gym sounds like the healthiest business you could ever start. You get to help people. You get to build a community. You get to walk into your own space every morning surrounded by people chasing a better version of themselves. But behind the treadmills and the motivational quotes on the wall sits one of the most brutal cost structures in all of small business. So what does it actually take to open the doors? Start with the building itself. A gym needs space. Real space. Somewhere between 3,000 and 15,000 square feet, depending on what kind of gym you're building. That space alone, before a single dumbbell is bolted to the floor, can run you tens of thousands of dollars a month in commercial rent, especially if you want visibility on a busy street or inside a shopping plaza where foot traffic already exists. Then comes the equipment. Cardio machines, strength racks, free weights, turf, mirrors, sound systems, locker rooms, showers. A single commercial treadmill can cost more than a used car. A full build-out of equipment for a mid-sized gym routinely lands between $150,000 and $500,000. And that's before flooring, HVAC upgrades to handle heavy breathing and heavy sweating, plumbing for showers, and the permits a city requires before it lets you open a space where hundreds of strangers will exercise every single day. Add staffing. Add insurance, which is steep for any business where injury is a built-in possibility. Add software for scheduling and billing. Add marketing to convince people your gym is worth leaving their current one for. Staffing alone deserves its own line item, because a gym isn't just one job. It's several jobs stacked on top of each other. Front desk coverage, often needed nearly every hour the doors are open. Certified trainers who expect to be paid for their expertise, not minimum wage. Group class instructors who may need to be paid per class regardless of how many people show up that day. Cleaning staff, because a gym that smells neglected loses members faster than almost any other kind of business. Each of those roles adds a fixed labor cost that keeps running whether the gym is packed at 6 in the morning or empty at 2 in the afternoon. Insurance deserves its own explanation too, because most first-time owners underestimate it badly. A retail store insures against theft and property damage. A gym insures against something far harder to price: the physical injury of paying customers, using heavy equipment, often without direct supervision, sometimes attempting exercises they've never done correctly before. General liability coverage is only the starting point. Many owners also need professional liability coverage for any trainers giving personalized advice, product liability coverage if they sell supplements or gear, and specific waivers reviewed by an attorney familiar with fitness law in their state, because a poorly worded waiver can be thrown out in court the moment it actually matters. None of this is optional. It's simply the cost of doing business in an industry where the product itself involves physical risk by design. By the time the doors open, most independent gym owners have sunk somewhere between $200,000 and $750,000 into a business that hasn't earned a single dollar yet. And most of that money doesn't come from savings. It comes from debt. A small business administration loan, a commercial equipment lease, sometimes a second mortgage on the owner's own home. That means the clock on repayment starts ticking the moment the loan closes, long before the first member ever walks through the door. Every month, the gym sits half empty isn't just lost revenue. It's a missed loan payment stacking on top of the next one. Lenders know this too, which is exactly why gym loans tend to carry stricter terms than loans for many other small businesses. Underwriters look closely at projected membership numbers, local competition, and the owner's personal experience running a fitness facility before approving anything close to the full amount requested. A first-time owner with no operating history in the industry often has to put up more personal collateral, accept a higher interest rate, or find an investor willing to share both the risk and the eventual reward. The money is available. It's just rarely cheap and rarely as fast as secure as a hopeful new owner initially expects walking into that first bank meeting. And that number changes dramatically depending on whether you're buying new equipment or refurbished, whether you're leasing a bare shell or taking over a space that already has plumbing and flooring in place, and whether your city treats a gym like a retail store or like a public assembly space requiring sprinkler systems and separate fire code approval. Two gyms with identical square footage in the same city can face startup costs tens of thousands of dollars apart, purely based on how the building was originally zoned. Here's the part almost nobody explains going in. A gym doesn't sell fitness. A gym sells a promise that most people will not keep. Chris Rondeau, who spent a decade as CEO of Planet Fitness before stepping away from the role in 2023, was remarkably candid about this for years. The company he helped build, alongside founders Michael and Mark Grondahl, turned into one of the largest fitness brands in the world, not by assuming everyone would show up every day, but by assuming the opposite. Planet Fitness set its standard membership at $10 a month specifically because the business model depends on a huge share of members paying and never coming in at all. Rondeau explained the underlying logic plainly. He and the founders looked at the fitness industry and noticed that roughly 80% of the population didn't belong to a gym at all, usually because they felt intimidated by traditional weight rooms and unwilling to pay high monthly fees for a habit they weren't confident they'd keep. So instead of fighting for the same 20% every other gym in town was already competing for, they built something specifically designed to make that other 80% comfortable enough to finally say yes. They called it the judgment-free zone, stripped away expensive amenities like pools and basketball courts, and let the $10 price point eliminate almost all hesitation. Think about what that means. The entire low-cost gym category, the model that now dominates the industry, was built on quiet absence, not loud attendance. And it's scaled to a genuinely staggering degree. Planet Fitness now counts tens of millions of members across thousands of franchise locations, operates on adjusted profit margins that would make most retail businesses jealous, and generates well over $1 billion in annual revenue, almost entirely from monthly fees smaller than most people's streaming subscriptions. So which kind of gym are you building? One that profits when people show up, or one that profits when they don't? That single decision changes almost everything downstream, starting with your margins. A premium gym, the kind with personal trainers, boutique classes, and a country club feel, might charge $150 to $300 a month per member. But it also carries far higher staffing costs, higher equipment costs, and a much smaller pool of people willing to pay that price. A low-cost gym charges a fraction of that, but needs enormous volume to survive and depends on the psychology Rondeau described. Both models can work. Both models can also collapse in almost identical ways. Let's look at a real case. Bahram Akradi founded Lifetime Fitness in 1992 with a very different bet than Planet Fitness. He had come to the United States from Iran at 17, worked his way up through the health club industry from cleaning pools to running sales, and eventually liquidated his personal assets to open a single club on a plot of land in Brooklyn Park, Minnesota, where 3 earlier gyms had already failed. Instead of stripping costs down the way Planet Fitness would a few years later, Akradi went the opposite direction, building resort-style facilities with pools, spas, and childcare, charging premium prices to people who wanted a lifestyle, not just a locker. For years, that bet paid off spectacularly. Lifetime grew into a public company generating over $1 billion in annual revenue, expanded across dozens of major metropolitan markets in the United States and Canada, and eventually attracted enough investor confidence that a group of private equity firms bought the entire company in 2015 in a deal worth billions of dollars. But the overhead of that model is staggering. Massive real estate footprints, constant renovation costs, high-touch staffing. When 2020 hit and gyms across the country were forced to close their doors, Lifetime's high fixed cost structure became a liability almost overnight, and the company took on hundreds of millions of dollars in new debt just to survive the shutdown, even as many of its low-cost competitors weathered the same crisis with barely a scratch. The industry-wide numbers from that period are worth sitting with. Rondeau himself later put a figure on it, saying that roughly 22% of all gyms in the United States closed permanently as a direct result of the pandemic. Within his own franchise system, not a single location filed for bankruptcy or closed for good. That gap between 22% industry-wide and 0% within one specific system isn't an accident of luck. It's a direct result of which cost structure each type of gym had built years earlier, long before anyone had heard the word lockdown. The low-cost, low overhead operators had enough margin of safety to survive a total revenue collapse for months. Many higher overhead independents simply didn't. That single data point should reshape how you think about risk in this industry. A gym doesn't just need to survive an average month. It needs a cost structure that can survive the worst month anyone can imagine, because eventually, in one form or another, that month arrives. Compare that to a small, no-frills strength gym with low rent, minimal staff, and simple equipment. That gym's revenue ceiling is much lower, but its fixed costs are lower too, which means it can survive slower months that would sink a premium facility. Notice the pattern already forming. Every choice an owner makes at the very beginning, the square footage, the amenities, the price point, quietly locks in a survival profile years before the first real crisis ever arrives. So what's the real profit margin on a gym? Industry data compiled by IHRSA, the International Health, Racket, and Sports Club Association, has shown for years that healthy, well-run fitness facilities typically operate on net margin somewhere between 10 and 20%. That sounds reasonable until you notice how thin the buffer actually is. Most of a gym's costs are fixed, not variable. Rent doesn't change whether you have 50 members or 500. Equipment loans don't pause because January's enthusiasm faded by March. Insurance doesn't care about attendance. Compare that to a business like a restaurant, where a slow night at least means lower food costs, because unsold ingredients simply don't get purchased or prepared. A gym doesn't get that relief. The treadmills run the electric bill whether one person uses them or 50. The trainer scheduled for a Tuesday morning session gets paid whether 3 people show up or none. That inflexibility is precisely why gym margins, even when healthy, rarely offer much cushion, and why an owner's real skill isn't running a great workout floor. It's forecasting demand accurately enough to staff and spend against a membership base that's constantly shifting beneath them. That means a gym's profitability depends almost entirely on filling a fixed amount of space with enough recurring revenue to clear a very high break-even line. Miss that line by even a small percentage, and a gym that looked profitable on paper can bleed cash every single month. Picture 2 gyms sitting side by side in the same strip mall, both with roughly the same rent, the same square footage, and the same equipment budget. One operates at 70% membership capacity relative to its break-even point. The other operates at 90%. On paper, that's a 20-point gap that sounds manageable. In practice, because almost every dollar of cost between them is identical and fixed, that 20-point gap in membership can be the entire difference between a business quietly building cash reserves and a business quietly running out of runway. Fixed-cost businesses don't fail gradually. They tend to look fine for months, right up until they don't. Here's a number that should stop you. The Small Business Administration has tracked failure rates across industries for decades, and fitness centers consistently sit among the higher-risk categories, with a significant share of new gyms closing within their first few years of operation. Walk through a simplified version of the math an owner actually faces. Say a mid-sized gym carries $15,000 a month in fixed costs: rent, loan payments, base staffing, insurance, and utilities combined. If the average member pays $40 a month, that gym needs 375 paying members just to break even before a single dollar of profit exists. Add in the marketing spend needed to fight churn every month, and the real break-even number climbs higher still. Now stretch that same gym across a 5,000 square foot space with a realistic equipment capacity of maybe 600 to 800 active members at any comfortable level of crowding, and the margin for error becomes obvious. This isn't a business that fails at 0 members. It fails anywhere below roughly half of its physical capacity, which is a far easier line to cross than most new owners assume walking in. Why does an industry built on health produce so much financial sickness? Think about the seasonality baked into the calendar itself. January brings a wave of new signups every single year, driven by resolutions and a fresh sense of motivation. Revenue spikes. Owners feel optimistic. But by March, a large share of those new members have already stopped showing up, even though many of them keep paying for months afterward out of habit or simple forgetfulness. By summer, attendance often dips again as vacations and warm weather pull people outdoors. A gym's cash flow isn't a smooth, predictable line. It's a wave that crashes and recedes on a yearly cycle, and an owner has to have enough cash reserved to survive the trough, not just enjoy the crest. Part of the answer is historical too. Go back to August of 1965, when a bodybuilder named Joe Gold converted a building he owned on Pacific Avenue in Venice Beach, California, into what he called the first gym made specifically for bodybuilders. It was a converted building with a concrete floor and homemade equipment, much of it hand-welded by Gold himself out of steel cable and scrap metal, using skills he'd picked up carrying dumbbells with him on merchant marine voyages for decades. The entire model was low-cost by necessity, not strategy. Bodybuilders paid small dues to use equipment nobody else in the world had, because in those days, as Gold's longtime friend and business partner Michael Uretz once put it, bodybuilders simply had no money. That original Gold's Gym became famous as the setting for the 1977 documentary Pumping Iron, launching the career of a young Arnold Schwarzenegger and turning bodybuilding from a fringe hobby into mainstream culture almost overnight. Gold himself sold the gym in the 1970s and went on to found a second chain, World Gym, which he ran until nearly the end of his life. Decades later, Gold's Gym International was sold to a hotel and hospitality holding company in a deal reported at roughly $160 million, a staggering final valuation for a business that started with welded scrap metal in a low-rent beach neighborhood. There's an even earlier piece of this history worth understanding, and it didn't come from the bodybuilding world at all. Judy Shepard Missett founded Jazzercise back in 1969, turning group dance-based exercise into a business model years before most people even used the word cardio. She had been teaching a demanding professional-style jazz dance class in Evanston, Illinois, and noticed something telling. Students kept dropping out, not because they disliked dancing, but because most of them had come for fitness, not for performance. So she redesigned the format entirely, removing the mirrors, removing the technical critique, and building something that felt joyful rather than intimidating. Her format required almost no equipment at all, just a room, a sound system, and an instructor. That low fixed cost structure let Jazzercise expand rapidly through franchising, and by the mid-1980s it had become, for a period, the second fastest growing franchise in the country behind only Domino's Pizza. Missett proved decades before Orange Theory or CrossFit existed that a gym doesn't need machines to succeed. It needs a reason for people to show up on a schedule and stay accountable to each other. That lesson keeps resurfacing throughout the industry's history, generation after generation, because the core problem never actually changes. Only the packaging does. For decades after that, gyms stayed relatively simple. Then, starting in the 1980s and accelerating through the 2000s, the category exploded into a spectrum. On one end, ultra-low-cost giants like Planet Fitness. On the other, ultra-premium operators like Equinox and Lifetime. The middle got squeezed, and squeezed hard. That historical shift matters because it explains why so many independent gym owners fail today. They open a mid-tier gym, charging mid-tier prices, competing against both the $10 giants and the luxury operators, without the volume of the first or the pricing power of the second. Which brings us to the first hidden trap almost nobody warns you about before you sign a lease. Membership churn. A gym doesn't just need new members. It needs to constantly replace the members who quietly cancel, stop showing up, or let their card expire without renewing. Industry estimates have long-placed average annual churn somewhere between 30 and 50% for many gym models. That means an owner isn't just running a fitness business. They're running a never-ending acquisition machine, spending money on marketing and promotions just to stay flat, let alone grow. Every member you lose has to be replaced before you've made a single dollar of actual growth. Doesn't that change how you'd think about a great opening month? Run the math on a single location. Imagine a gym with 1,000 members paying $50 a month. That's $50,000 in monthly revenue, which sounds healthy. But if annual churn sits at 40%, that gym needs to sign up roughly 33 new members every single month just to stand still. Not to grow, just to stay exactly where it already was. Every dollar spent on advertising, referral bonuses, or promotional free trials that month isn't chasing growth at all. It's plugging a hole that opens up automatically every month, forever, for as long as the gym exists. That constant replacement need creates a second, related number owners rarely calculate honestly at the start: customer acquisition cost. Between digital advertising, printed flyers, referral incentives, and the free first month so many gyms offer to get someone through the door, the true cost of winning a single new member can run anywhere from $50 to several $100s, depending on the market and the competition. If a gym charges $30 a month and spends $150 to acquire that member, it takes 5 full months just to break even on the acquisition cost alone before that member has contributed a single dollar of actual profit. And if that member churns out in month 4, the gym has lost money on that customer relationship entirely. Multiply that dynamic across hundreds of members cycling in and out every year, and you start to see why marketing isn't a discretionary expense in this industry. It's closer to a second rent payment due every single month, whether an owner budgeted for it or not. Ellen Latham, a trained physiologist who founded Orange Theory Fitness in Fort Lauderdale, Florida, in 2010, built her entire model around attacking this exact problem. Orange Theory doesn't just sell membership. It sells a scheduled class, a heart rate monitor, and a screen showing your effort in real time compared to everyone else in the room. That structure creates a sense of obligation and social accountability that plain equipment-based gyms struggle to replicate, and it measurably reduces the quiet, invisible dropout that kills so many traditional facilities. The model spread fast enough that within a little over a decade, Orange Theory had grown to more than 1,000 studios across dozens of countries. The second hidden trap is even less visible from the outside: equipment depreciation and replacement. A treadmill running 12 hours a day, 7 days a week, wears out far faster than a treadmill in someone's home. Commercial gym equipment typically needs significant maintenance or full replacement every 5 to 7 years. Multiply that across dozens of machines, and a gym owner is quietly staring down a 6-figure reinvestment bill roughly once every half-decade, often right around the time the original loan is finally paid off. Most new owners budget for opening costs. Very few budget for the second build-out that's coming whether they're ready for it or not. There's a quieter version of this trap, too. A single broken cable machine or a treadmill with a dead motor doesn't just cost money to fix. It sits there, visibly broken for days or weeks while parts get ordered, and every member who walks past it during that time absorbs a small, cumulative impression that the gym is being neglected. That impression is one of the most common reasons members give, quietly, for canceling a membership they otherwise liked. The cost of deferred maintenance isn't just the repair bill. It's the invisible churn that broken equipment generates long after it's finally fixed. This is exactly why larger operators budget for equipment as an ongoing operating cost rather than a one-time purchase, setting aside a fixed percentage of monthly revenue specifically for maintenance and replacement rather than waiting until a machine fails to find the money. Independent owners, stretched thin by rent and payroll in the early years, often skip that step entirely, treating the original equipment purchase as a cost they've already paid rather than a slowly depreciating asset with a countdown clock attached. By the time that countdown reaches 0, the bill arrives all at once, usually during the exact years an owner had finally started to feel like the business was stable. Now compare 2 different paths an owner might take once the gym is up and running. The first path is the franchise route. Peter Taunton co-founded Snap Fitness with Chad Kirchhoff in 2003, opening the first location in River Falls, Wisconsin, the following year, and built the company specifically around solving the 2 problems above. Franchising standardizes equipment purchasing, marketing systems, and even churn reduction playbooks, spreading the cost of solving those problems across thousands of locations instead of forcing each owner to solve them alone. The trade-off is obvious. You pay ongoing franchise fees, and you give up a portion of control over how your business runs. Those fees typically show up in two forms. An upfront franchise fee paid just to license the brand and its systems, often tens of thousands of dollars before a single piece of equipment is purchased. And an ongoing royalty, usually a percentage of monthly revenue, paid for as long as the location stays open under that brand name. On a good month, that royalty feels like a fair price for a proven playbook. On a slow month, it's one more fixed obligation sitting on top of rent, staffing, and equipment loans, due regardless of how many members actually walk through the door. Chuck Runyon co-founded Anytime Fitness in Minnesota alongside Dave Mortensen and Jeff Klinger, after the three of them had already spent 7 years running a single health club together and studying exactly what long-term members actually wanted. What they heard over and over was convenience. So they built a model around 24-hour key fob access using radio frequency ID cards, letting members work out any hour of the day or night with minimal staffing required outside of business hours. That single design choice slashed one of a gym's largest recurring costs, labor, while still letting the company charge for round-the-clock availability. Runyon later admitted the company even had to lobby state and city lawmakers in places like California, Illinois, and New York, whose existing regulations hadn't anticipated a gym that operated without anyone at the front desk overnight. It's a reminder that in this industry, the biggest profit gains often come from removing a cost most competitors assume is fixed, not from adding a new revenue stream. Interestingly, the fitness franchise world has kept consolidating around exactly these efficiencies. Anytime Fitness's parent company eventually merged with Orangetheory's parent company in 2024, bringing Ellen Latham's accountability-driven boutique model and Chuck Runyon's convenience-driven access model under the same corporate roof, a sign of just how much value large operators now place on owning multiple solutions to the churn and cost problems at once, rather than betting everything on just one. It's also worth noting that Taunton and Runyon weren't operating in a vacuum. A much older company, 24-Hour Fitness, had already been running large format, round-the-clock gyms for a quarter century by the time Snap Fitness and Anytime Fitness launched their smaller, leaner versions of the same idea. But 24-Hour Fitness built its clubs at roughly 25 times the size of a typical Snap Fitness location, which meant carrying a completely different cost structure, with far higher rent and far higher staffing needs per location. The smaller franchise model that followed wasn't really a new idea. It was the same convenience proposition, delivered at a fraction of the fixed cost, which is exactly the kind of insight that tends to define which businesses in this industry scale efficiently and which ones simply scale their overhead alongside their revenue. The second path is the independent, boutique specialization route. Greg Glassman founded CrossFit with his then-wife Lauren Janai in 2000, after years spent developing an unconventional training philosophy while working with police officers and everyday clients out of rented space inside a Brazilian jiu-jitsu dojo in Santa Cruz, California. Instead of franchising in the traditional sense, CrossFit licensed its name and methodology to independently owned affiliate gyms, often small spaces with minimal equipment and high-intensity group classes instead of endless rows of machines. That model kept startup costs dramatically lower than a traditional big-box gym, while building fierce community loyalty that reduced the churn problem almost by design. Within roughly 2 decades, the affiliate network had grown to more than 15,000 independently owned locations worldwide, before Glassman stepped down in 2020 and sold the company to investor Eric Roza. 3 founders, 3 franchise philosophies, and yet all chasing the exact same underlying spreadsheet. How do you lower fixed costs, raise loyalty, and survive long enough for compounding to work in your favor? So which trap are you better positioned to solve? The high fixed cost, high churn problem of a big box gym, or the lower cost, higher loyalty model of a specialized studio? Harvard Business School professor Michael Porter has spent decades studying exactly this kind of decision across industries, describing it as the difference between competing on cost leadership and competing on differentiation. A business caught in the middle, without a clear commitment to either strategy, tends to underperform both types of competitors. Gyms may be the clearest real-world example of that theory, playing out in strip malls across the country. Watch what happens to a gym that tries to straddle both strategies at once. It charges more than Planet Fitness, so it loses the price-sensitive shopper who wants the cheapest possible option. But it doesn't offer the pools, spas, or personal service of a Life Time or an Equinox, so it also loses the shopper willing to pay a premium for a genuinely elevated experience. What's left is a gym competing on neither price nor distinction, forced to win members through pure proximity and hope, which is a far harder position to defend once a lower-cost or higher-service competitor opens nearby. Economist Tyler Cowen has written extensively about how subscription-based businesses succeed or fail based on exactly this kind of behavioral math, noting that recurring payment models often thrive specifically because a portion of paying customers stop actively using the product without bothering to cancel. Gyms didn't invent that dynamic, but few industries depend on it as heavily or as visibly as fitness does. It's worth sitting with how unusual that really is. In most industries, a customer who stops using a product simply stops paying for it soon afterward. In fitness, an entire category of major companies has built durable, multi-billion-dollar valuations, partly on the assumption that a meaningful share of customers won't do that. That's not a criticism of the model. It's simply the honest mechanics underneath a business most people walk into assuming is about equipment and encouragement, when it's often really about behavioral inertia and billing cycles. Now think about scale. What happens when a single gym succeeds and an owner wants to open a second location? This is where the real economics either compound in your favor or expose every weakness in the original model. A second location doubles rent, doubles staffing, doubles equipment costs. But it doesn't double your negotiating power with suppliers, doesn't double your brand recognition, and doesn't automatically double your member base in a new neighborhood that's never heard of you. Successful multi-location owners tend to solve this by centralizing what can be centralized. Shared management software, shared marketing budgets, shared purchasing power for equipment, which lowers the cost per unit as volume increases. That's exactly the leverage franchise systems like Snap Fitness, Anytime Fitness, and Planet Fitness were built to provide from day one, which is part of why franchised fitness locations have expanded so aggressively compared to independent openings over the past 2 decades. But scale introduces its own hidden cost. Every additional location adds another layer of management distance between the owner and the day-to-day experience members actually feel. Lose that experience, and the churn problem above gets dramatically worse at exactly the moment an owner has the least time to personally fix it. There's also a financing wrinkle that catches many growing owners off guard. Lenders evaluate a second location almost as if it were a completely new business, regardless of how well the first one performs, because a new location has no attendance history, no local reputation, and no proof it can hit the same break-even numbers in a different neighborhood. That means a successful owner often needs nearly as much startup capital for Location 2 as they needed for Location 1. Even though on paper, they look like a far safer bet than any first-time owner walking in off the street. Franchise territory rights add another layer few outsiders think about. When a franchise owner buys the rights to a specific zip code or radius, they're not just buying permission to open one gym. They're buying the exclusive right to expand within that footprint before a competitor under the same brand can claim it. Owners who understand this early tend to lock down high-growth areas before property values and lease rates catch up to demand, effectively buying future expansion capacity at today's prices. Owners who wait, hoping to prove out Location 1 before thinking about Location 2, sometimes find the best territory in their market already gone by the time they're ready to grow, claimed either by a competitor franchisee or by a corporate-owned location the parent company decided to build itself. Consider a second real-world comparison. Independent boutique studios, the kind built around a single charismatic owner or instructor, often generate extraordinary loyalty at one location, precisely because members feel a personal connection to the person running the room. But that same loyalty becomes nearly impossible to replicate the moment a second, third, or fourth location opens without that founder physically present. Franchise systems solve this by designing the experience around a repeatable process rather than a specific person, which sacrifices some of that magic in exchange for something far more valuable at scale: consistency. That trade-off explains why so many beloved single-location gyms never expand at all, even when demand clearly exists. The owner understands, often instinctively, that the thing keeping members loyal isn't easily transferable to a location they won't personally run. Staying small isn't always a failure of ambition. Sometimes it's the more rational economic choice, given exactly what's driving that gym's low churn in the first place. There's a useful way to think about which category any given gym actually falls into. Ask what would happen to member loyalty if the founder simply disappeared tomorrow. At a big box, low-cost gym, the answer is usually very little, because the value proposition was never about a person. It was about price, access, and convenience. At a boutique studio built around one instructor's personality and coaching style, the answer can be dramatic because the members were never just buying a workout. They were buying a relationship with a specific person standing in front of them each class. Neither answer is wrong, but an owner who mistakes one model for the other, expanding a personality-driven studio the way a franchise would expand a commodity gym, often finds that growth quietly erodes the exact thing that made the original location successful. Eventually, most successful gym owners face a final decision that rarely gets discussed publicly: the exit. Some owners sell to bigger regional or national chains once they've proven a location can sustain healthy margins, effectively converting years of thin profit into one larger lump sum payout, the same way Lifetime's founder eventually brought in outside private equity partners once the company had proven its model at scale. Others choose to keep the business as a long-term income stream, accepting lower annual profit in exchange for ongoing control. A smaller number expand aggressively themselves, essentially becoming their own regional franchise, chasing the same economics that turned Planet Fitness and Lifetime into billion-dollar companies in the first place. Buyers in this industry, whether private equity groups or larger fitness chains, tend to value a gym almost entirely on the predictability of its recurring revenue rather than its physical assets. A gym with stable membership numbers, low churn, and clean financial records over several years can command a purchase price many multiples higher than one of similar size with erratic attendance and thin bookkeeping, even if the two facilities look nearly identical from the parking lot. That means every decision an owner makes in year one, from how carefully they track membership data to how consistently they collect payments, is quietly shaping a sale price that might not materialize for another decade. That valuation math also explains why so many fitness brands eventually end up owned by private equity rather than by their original founders. A recurring revenue business with predictable churn and a repeatable cost structure is exactly the kind of asset that institutional investors are built to price and hold. Lifetime's sale to a group of private equity firms in 2015 and the eventual private equity ownership behind brands stretching from Orange Theory to Equinox aren't isolated events. They're the natural endpoint of an industry where the underlying product, a recurring membership with predictable attrition, behaves less like a gym and more like a financial instrument once it reaches sufficient scale. The workout floor is still the workout floor, but somewhere above it, on a spreadsheet an average member never sees, the business has become something closer to a bond with a treadmill attached. There's no universally right exit. There's only the exit that matches the cost structure and the risk tolerance an owner chose back on day one, whether they realized they were choosing it or not. Buyers in this industry, whether private equity groups or larger fitness chains, tend to value a gym almost entirely on the predictability of its recurring revenue rather than its physical assets. A gym with stable membership numbers, low churn, and clean financial records over several years can command a purchase price many multiples higher than one of similar size with erratic attendance and thin bookkeeping, even if the two facilities look nearly identical from the parking lot. That means every decision an owner makes in year one, from how carefully they track membership data to how consistently they collect payments, is quietly shaping a sale price that might not materialize for another decade. So picture the decision in front of you. right now, if you were the one signing that lease? Would you build a low-cost gym, betting on absence the way Chris Rondeau and the Grondahl brothers did? Would you build a premium facility, betting on loyalty and lifestyle the way Bahram Akradi did? Would you buy into a franchise system that solves your churn and purchasing problems for you, the way Peter Taunton and Chuck Runyon each designed theirs to do? Would you attack churn head-on with accountability and data, the way Ellen Latham built Orange Theory to do? Or would you build something smaller, more specialized, and fiercely community-driven, the way Greg Glassman reimagined an entire industry out of a rented room in a jiu-jitsu dojo? Every option carries a version of the same brutal fixed cost, high churn math running quietly underneath it. Joe Gold learned at welding equipment out of scrap metal on a beach in 1965. Judy Shepard Missett learned at teaching a dance class in Evanston in 1969. Every founder since has just been solving the same equation with different tools. Owning a gym never really sounded like a business. It sounded like a mission. But underneath every treadmill, every mirror, and every motivational quote on the wall, it always was one.